Have you ever looked at your savings account and wondered why the interest rate is so low? While banks seem to be making a fortune, it feels like you're earning pennies while they're raking in dollars. What if I told you there's a way to flip the script, a way to earn yields of 8%, 10%, or even higher, essentially by acting like a bank yourself? It's called private credit, and it's one of the fastest growing corners of the financial world. Today, we're going to demystify private credit, explain how it works, and explore how you might be able to get a piece of the action. So, what exactly is private credit? In simple terms, it's lending money directly to companies, outside of the traditional public markets, like bonds or bank loans. Think of it like this. A medium-sized company wants to expand, maybe build a new factory or acquire a competitor. They need a loan. Instead of going to a big bank, which might have strict, slow-moving processes, they turn to a private credit fund. This fund, which has raised money from investors, lends them the capital they need. In return, the company pays interest to the fund, and that interest is then passed on to the investors. You might be asking, why would a company choose this over a bank? Well, after the 2008 financial crisis, regulations on banks got a lot tighter. This made them more cautious about lending, especially to mid-sized businesses that might be seen as slightly riskier. This created a gap in the market. Private credit funds stepped in to fill that void. They can be more flexible, faster, and offer customized loan terms that a traditional bank might not. For the company, this means getting the capital they need to grow quickly and efficiently. For the lender, the private credit fund, it means an opportunity to earn a higher interest rate to compensate for that flexibility and perceived risk. Now for the exciting part, the returns. This is where private credit really shines, because these loans are not publicly traded and are often made to companies that quickly and easily access public markets. The interest rates, or yields, are significantly higher. We're often talking about yields in the range of 8% to 12%, or even more. Compare that to the interest on your savings account or the yield on a typical government bond, and you can see the appeal. The loans are also often floating rate, which means the interest rate they pay goes up when central bank rates go up. This has made private credit incredibly popular in the recent environment of rising interest rates, as it provides a natural hedge against inflation. Let's break down how a typical deal works. Imagine a private equity firm wants to buy a software company. They need, say, $500 million. They'll put up some of their own money, but they'll need to borrow the rest. A private credit fund might step in and provide a $300 million loan. This loan is senior secured, which is a key term to understand. Senior means if the company gets into financial trouble, the private credit fund is one of the first in line to get paid back. Secured means the loan is backed by the company's assets, like its intellectual property, equipment, or real estate. This seniority and security provide a crucial layer of protection for the investors in the private credit fund. So, who are the big players in this space? You'll hear names like Blackstone, Apollo, KKR, and Ares. These are massive global investment firms that manage hundreds of billions of dollars. They have huge teams of experts who specialize in finding good companies to lend to, doing deep research, what's called due diligence, and structuring the loans to protect their investors' money. They'll analyze a company's cash flow, its management team, its position in the market, and its growth prospects before ever lending a single dollar. It's a highly specialized field that requires a lot of expertise. This probably sounds great, but you're likely thinking, this is for huge institutions and billionaires, not for me. And historically, you'd be right. For a long time, accessing private credit required you to be an accredited investor with millions to invest, and you'd have to lock up your money for many years. But things are changing. The industry is starting to democratize. We're now seeing the rise of funds specifically designed for individual investors. These are often called BDCs, or business development companies, and interval funds. BDCs are a popular way for regular investors to get exposure. They are companies that are publicly traded on stock exchanges. Just like Apple or Microsoft, you can buy and sell their shares through a standard brokerage account. BDCs invest their money primarily in the debt of private, mid-sized U.S. companies. So, by buying a share of a BDC, you are indirectly investing in a diversified portfolio of these private loans. This gives you liquidity, the ability to sell your shares on access to those attractive high yields. Interval funds are another growing option. They are a type of mutual fund, but with a twist. Instead of being able to sell your shares any day, you can only sell them at specific intervals, usually once a quarter. This structure allows the fund manager to invest in less liquid assets, like private credit loans, without having to worry about daily redemptions. This lack of daily liquidity is a trade-off, but it's what enables the fund to target those higher-yielding private investments. They often have lower minimum investments than traditional private funds, making them more accessible. Of course, no investment comes without risk. Higher returns always come with higher risk, and it's crucial to understand them. The biggest risk in private credit is credit risk, or default risk. That's the risk that the company you've lent money to can't pay it back. If a company goes bankrupt, you could lose some or all of your investment. This is why the due diligence process by the fund managers is so critical. They are the gatekeepers, and their job is to pick winners and structure deals to minimize potential losses. Another risk is illiquidity. As we mentioned, these are private loans. You can't just sell them on a stock market tomorrow. If you invest in a traditional private credit fund, your money might be locked up for 7 to 10 years. Even with more accessible options like BDCs and interval funds, there are still liquidity considerations. BDCs can be volatile, and their share prices can trade at a discount to the actual value of their underlying assets. With interval funds, you have to be prepared to wait until the next repurchase period to get your money out. There's also economic risk. If we enter a deep recession, more companies will struggle, and default rates across the board will likely rise. While private credit has performed well through past economic cycles, a severe downturn would certainly test the resilience of these portfolios. That's why diversification is key. By investing in a fund that holds loans to hundreds of different companies across various industries, you spread out your risk. If one company defaults, it has a much smaller impact on your overall return. So, how can you decide if private credit is right for you? First, consider your risk tolerance and time horizon. This is not a get-rich-quick scheme. It's a strategy for earning a high level of income over the medium to long term. You need to be comfortable with the illiquidity and the inherent credit risk. Second, do your homework. If you're looking at ABDC, research it just like you would any other stock. Look at its management team, its track record, the diversity of its portfolio, and the fees it charges. Fees are important, as they can eat into your returns. Third, think about how it fits into your overall portfolio. Private credit can be a great diversifier because it's not traded on public markets. Its performance doesn't always move in lockstep with the stock or bond markets. This can help smooth out the returns of your overall portfolio. Many financial advisors suggest allocating a small portion, maybe 5% to 10%, of your investment portfolio to alternative assets like private credit. In summary, private credit is an asset class that allows you to lend directly to companies and earn attractive, income-focused returns. It was once the exclusive domain of large institutions, but new products like BDCs and interval funds are opening the doors for more investors. The key is to understand the trade-offs. In exchange for those high yields, you are taking on credit risk and giving up some liquidity. It's not a free lunch, but for investors who understand the risks and have a long-term perspective, it can be a powerful tool for generating income and diversifying a portfolio. It's about changing your mindset from just a saver to an investor who can, in a way, earn like a bank. Thank you so much for watching. If you found this explanation helpful, please hit that like button and subscribe for more deep dives into the world of finance and investing. Let me know in the comments if you have any questions about private credit or if there are other topics you'd like me to cover. See you in the next video.